Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, we'll be joined by our guest co-host, Gavin Graham, Chief Investment Officer at Spire Wealth Management. And later, our featured guest, Dominique Lapointe of Manulife Investment Management, will break down Canadian GDP numbers for the month of October with us when they are released at 8:30. And we want to hear from you as well on First Call. Reach us with your questions on North American and global large caps, and we will have Gavin answer as many of those questions as he can. The number to call, 1-855-326-6266. Phone lines will open in about 30 minutes, and our email address is firstcall@bellmedia.ca. Now, some of the stories we are tracking for you in the BNN Bloomberg newsroom. The Canada Pension Plan Investment Board and Goodman Group have agreed to set up a multi-billion-dollar European data center business. The Australian Industrial Property Investment Manager and the Canadian Pension Fund Manager will initially invest close to $4 billion Australian dollars to develop data center projects in Frankfurt, Amsterdam, and Paris. Construction is due to start by the end of June. Alphabet has agreed to buy clean energy developer Intersect Power for $4.75 billion US in cash plus existing debt. This is one of the largest deals by the tech giant to expand its data center footprint in AI. The acquisition is intended to give Alphabet's Google access to more electricity for its data centers. The AI race has spurred mergers and acquisitions in the data center and power industries. Shares of Novo Nordisk are climbing in the pre-market. The drug manufacturer has received approval to sell a pill version of its obesity shot Wegovy in the U.S. The Danish company will start selling the pill in early January. The company says it filed for approval in Europe and other parts of the world in the second half of 25. The pill is crucial for Novo's strategy to take on rival Eli Lilly. And time now for our top line story. Copper has hit a fresh all-time high above $12,000 a ton as severe mine outages and trade turmoil put the metal on course for its biggest annual gain since 2009. Let's bring in our guest co-host, Gavin Graham, Chief Investment Officer at Spire Wealth Management. Gavin, thanks as always for joining us.
Good to be here, Roger.
Your thoughts on where copper is heading? Is this the start of something, or are we at a peak, do you think?
Well, it's certainly not the start of something because it's been going up pretty strongly for the last little while. And again, your two leading stories this morning were about data centers and about buying clean electricity supply to provide power to data centers. What do you need for electrical connections? Oh, yes, copper. And you need lots of it, and there isn't enough around, and it takes at least 5, if not 10 years to get a new copper mine into operation. So it's very likely the price of copper is going to keep on going. And again, that's not even mentioning the electrification of the auto market, where you need lots and lots of copper, and indeed lots of other metals as well, to actually bring out this electrification. So it's highly unsurprising that copper is hitting an all-time high. But if you're going to ask which direction is it likely to go, with obviously a lot of volatility, upwards, I think, is the answer.
Any concerns about China, the demand there not as great as expected, but yet there's still this, people are buying up copper just to have it?
Well, one of the reasons you're buying up copper is because you're not certain about supply. There could be a supply crunch, and we see that in one or two other metals as well, where suddenly sort of the ability to ship metals around the place gets affected by tariffs. Again, one of the reasons perhaps for copper's particular strength in the last little while has been worries about maybe there could be some imposition of tariffs on refined copper as opposed to unrefined. We had an early flurry of those worries earlier this year after the Liberation Day announcements. So China's demand is obviously a major driver, but the fact is it's North America and Europe again, also need lots of copper as well. And there is not enough of it around. This is all very basic, Roger, and one doesn't want to seem too simplistic. But if the supply is limited, and environmental and political aspects means it takes a very long time to get new supplies into production, then the only solution is to actually have the price get high enough to make it worthwhile for more supplies to be brought on.
And from an investment perspective, what do you do with this then?
Well, and I think we've touched on this one or two of my previous appearances, but there are a number of pretty interesting copper companies. In Canada, particularly, you've just had the takeover of Teck Resources by Anglo American, approved by the federal government in 3 months, which is pretty remarkable. When Glencore bought Teck's coal business a couple of years ago, that took 8.5 months. So I think everyone has been very pleasantly surprised by how quickly that deal's gone through. And the reason the deal went through, obviously, is that it's a very big strategic copper resource. And by putting Teck and Anglo American together, you get the opportunity of their big Chilean mines next to each other, getting a lot of efficiencies. But there's companies like First Quantum, London Mining, all of which are listed in Canada, and all of which are seeing substantial increases in their copper output. So those are all ways you can look at it as a means of playing this story.
Now, we're also seeing record highs with gold and silver again today, but other metals as well are in on the run, aren't they?
They are. And again, this is a fairly widespread. Firstly, it's an industrial commodities bull market because of the electrification boom, whether it's AI or autos. But also you're seeing the safe haven trade. People are worried about where the US dollar is going, and whichever person President Trump chooses to replace Jay Powell at the Federal Reserve next May is going to get lower interest rates. All of the major candidates have said they're in favor of lower interest rates. So support for the dollar will be removed or weakened because interest rates will be coming down at a time when they may stop coming down in other countries. We saw, for example, the Fed cutting interest rates a couple of weeks ago and the Bank of Canada didn't. And at the same time, also, you're worried about whether you'll be able to access your US dollars after what happened with the Russian invasion of the Ukraine, and there was a freeze on Russian assets. So people are going, precious metals, that's a safe store of value, which is nobody else's liability. And by the way, there's a bit of inflation as well. So the best performing asset class this year, Roger, has been gold. The best performing stocks have all been gold. So even though we've had the Magnificent Seven and the AI boom, it's been little old gold miners and precious metals miners that actually have been leading the pack.
Okay, we're going to leave it there for now, but we will be back with you, Gavin, and we're going to take a look, though, at the markets before the bell. All right, let's see how things are shaping up on the markets. And we'll start with U.S. futures. Pretty much a wash at this point. 0.07% for the Dow. It's off. NASDAQ off by 0.08. S&P 500 off by 0.05. We'll see if the Santa Claus rally, I guess we're officially into it today. We'll see what happens with that as we head towards the end of the year. Moving over to Asia now. And it's mixed there. Bit of a Nikkei, again, a wash. Hang Seng down by 0.1% roughly. CSI 300 up by 0.2. Everybody a little mixed. Everything's settling down for the end of the year. They want to get into the holidays, I think. The FTSE 100, it's a wash there. That's my word for the day. CAC 40 up by 0.25 point. And the DAX pretty much neutral right now. And the TSX yesterday, the rally continues for it. We'll see what happens into today, but it was up by 0.77%, closing record territory with 32,000 yen. And looking at the metals that we were just talking about, and you can see gold is up. All of them are in record territory. Silver topping $70 right now an ounce. Gold over $4,500 an ounce. And copper is at $5.59, more than 12,000 per ton. So everything sitting in record territory as we start to wind down the year. As for oil, a little bit of a different story there. There was a bounce back for it, though. Western Canadian Select up more than 3% to 44.66, still down for the year. And south of the border, WTI, what is it doing right now? You can see it is up slightly at 58.14. It's bounced back after that 5-year low of $55 around that mark there. Back up over 58 now. Still down for the year by 16%. Canada has just announced a new ambassador to the United States. Mark Wiseman will replace Kirsten Hillman in February. The change comes at a crucial time as Canada gets set to renegotiate our existing trade agreement with the U.S. and Mexico. CUSMA has so far shielded the Canadian economy from the worst of the effects of tariffs. CTV's Jeremy Sherrill reports.
He is a global investment banker, pension fund manager, and friend of Prime Minister Mark Carney. Now, Mark Wiseman will be Canada's next ambassador to the U.S.
There is going to be an enormous amount of hurdles and landmines that the ambassador is going to have to walk through.
He steps into what is widely viewed as Canada's top foreign post without any diplomatic experience, but the Prime Minister's office points to his extensive experience at American financial institutions and knowledge of capital markets on both sides of the border.
He brings that outside of politics, real-world experience that I think will be of benefit to the country for sure.
In a social media post announcing the appointment, the Prime Minister says, as a core member of our negotiating team, I know he will advance the interests of Canadian workers, businesses, and institutions.
Carney is betting that Wiseman's finance credentials will command the attention and the respect of Trump.
A bet that couldn't come with higher stakes for the trade relationship between the two countries.
And there's a lot of anxiety over sectoral tariffs and then the CUSMA review. So really important here in this case that the Prime Minister has recruited someone who's a globally recognized deal maker.
In 2025, the current CUSMA deal helps shield Canada from the worst impacts of tariffs. But with its review set to begin in the new year, there are no guarantees.
The president can and quite possibly will walk away from this agreement. And if he does, then I think all bets are off.
Sources tell CTV News Wiseman won't be alone at the negotiating table. The Prime Minister, along with Dominic LeBlanc, the Minister in charge of Canada-U.S. relations, will also play critical roles. Jeremy Sherrill, CTV News, Ottawa.
And let's bring back our guest co-host, Gavin Graham of Spire Wealth Management. Gavin, your thoughts on this appointment?
Well, Mark Wiseman is an extremely experienced financial services executive, head of the Canada Pension Plan, at Ontario Teachers before that, Alberta Investment Management. And he's also quite well connected with Larry Fink, the CEO of BlackRock, who is a close ally of Mr. Trump. So even though he doesn't have the diplomatic experience, he does have the confidence of the Prime Minister, who he's a good friend of. He does have a lot of experience of dealing with international relations. He comes from a legal background originally. So it is likely that he's quite a strong appointment in terms of his knowledge of the economic side of things. One of his particular areas of interest, apparently, is he feels supply management, i.e. keeping the supply arrangements which benefit dairy farmers and the like in Canada, is not a particularly good idea, which has been one of the major bugbears for the Trump administration. So therefore, it's possible that that might be an area where it would be relatively straightforward to come to some agreement, and that would be an easy win. Although, as the report was saying, the Canada-US-Mexico agreement does expire middle of next year. Of course, Mr. Trump renegotiated it himself in his first term, said it was the best trade deal ever. That doesn't necessarily mean, of course, that that is still the case in his mind, but he does have some ownership of it. And if one or two obvious areas of annoyance are removed, then it's a possibility that you will see something happening that will be fairly productive. In the meantime, it's very notable that I believe a couple of analysts have said that barely, sort of 5 to 10% of Canada's exports to the States have been affected by tariffs because the rest is covered by CUSMA. There are some obviously, exceptions like steel and aluminum, but in general, it's done a very good job of protecting Canada from the worst of the tariff storm.
I just want to go back to a couple of things you said. First up, he's not really doesn't have a diplomatic background, but does that really matter to if you're dealing with someone like Donald Trump? The business is more important to him, isn't it?
It is, although, of course, Mr. Trump's definition of business may differ from other major players in that space. He's very deal-oriented, I think it's fair to say. But no, you're absolutely right. It matters a great deal less with this administration in the US than previously to have diplomatic experience, simply because Mr. Trump and the administration is rewriting a lot of what we've taken for granted as the diplomatic rules in the post-World War II era, which is fair enough because it is, after all, over 80 years since World War II. We've had, with the Russian invasion of Ukraine, the first major sort of breaching of European borders since World War II. It is a new world out there. You may not like it, but you have to say that someone who's able to deal with the realities as they are, rather than somebody who is still working within the previous framework, is probably going to do a better job.
And where do you see his role within the negotiations? We've got a prime minister with a business background, but we also have a prime minister that wants to protect the dairy industry. Could that be a conflict on the Canadian side?
Well, I think it's going to, we've said Mr. Trump is very deal-oriented and he looks for wins. He has made it very plain. He thinks supply management is an area where there is unfair discrimination against US dairy exports into Canada. And quite frankly, if you were to be the Prime Minister, you might consider it worthwhile to actually pay the dairy industry the equivalent of what they're getting from supply management, just give them checks and get rid of it as a major aggravation for US-Canadian relationships. Because you're paying money one way at the moment by all of us paying higher milk and dairy prices to protect the dairy farming industry. If you gave the dairy farmers equivalent cash, then they would not be worse off, and the US would have a major aggravation removed.
Could you see him leading a little more? Or is this still the Prime Minister's his role on this one when it comes to the free trade agreement? Sorry, the word was eluding me there for a sec. Could you see him taking the helm on this, or will it be the Prime Minister still?
I would think it's probably the single most important piece of international legislation that the government is going to have to deal with. I'm sure the Prime Minister will be leading on it. But if he's working with a close friend who comes from a very similar background and has negotiating chops, then I'm sure that Mr. Wiseman will be helpful in the various processes that are involved.
Okay, we'll leave it on that note there, but Gavin will be back to see why Agnico Eagle is on your radar. Stick with us. All right, time now to see what is on Gavin Graham's radar. He is, of course, from Spire Wealth Management. And first up, Gavin, Agnico Eagle. What are you liking about that?
Yes, well, it's the biggest gold company in the world by market capitalization now, I believe, having overtaken Barrick and Newmont, partially because both of those did a pretty bad job in terms of managing their portfolios over the last few years, which has seen a change of management of both of them. Agnico is absolutely the opposite. It's very well managed, always have been regarded as being so, and it's actually made a couple of acquisitions in Canada, Kirkland Lake and the Quebec assets of Yamana, which have enabled it to grow its production to over 3.3 million ounces. It's done extremely well, but actually it's still, would you believe, despite that chart, Roger, it's still a laggard this year. It's only up 120%, and the gold miners, the GDX, is up 140 because some of the smaller ones, obviously, who are more leveraged to the price of gold, have done even better. You even get a 1% dividend while you're waiting. And realistically, if you believe that it's likely the US dollar is going to weaken because interest rates will be cut, if you believe there's more political uncertainty out there, we're seeing it with Venezuela and Ukraine and the like, then gold's going to continue to do pretty well. This is one of the largest gold miners in the world. All its mines are in politically stable jurisdictions. And as I mentioned, you even get paid a little bit of a dividend, 1%, which they are increasing. So I think it looks attractive.
And have you heard of any more M&As for it?
No, and they have been very, very selective. The worst thing about mining companies, as you may remember, Roger, is their tendency to make dilutive acquisitions at the top of the market, and which causes pain and suffering all around, which is what happened at the end of the previous gold bull market when it hit 1,800 back in 2010-11. And Agnico have always remained very disciplined and stuck to their last, which is brilliant. But if there were to be another, sort of accretive acquisition coming along, then they'd certainly look at it.
Okay, let's move on. These aren't getting a lot of love right now, but REITs, then the one you're liking is Canadian Apartment REIT.
Absolutely, and it's down 25% over the last 5 years, would you believe, Roger, at the time when I certainly haven't noticed an absence of demand for Canadian rental accommodation. Obviously, interest rates went up a lot in the first couple of years, and in the meantime, the Canadian Department, which is the largest multifamily residential in Canada, has been reshaping its portfolio, sold off 15,000 units, the vast majority in Europe, Germany, Netherlands, and it's also been recycling a lot of its Canadian portfolio. Sells about a 25% discount to its NAV, at which stage you've always generally seen that narrow in. Interest rates are coming down. They've come down by over 2.5% in the last 18 months. And in the meantime, you get a 4.4% yield while you wait. So we think that this will be a beneficiary of lower interest rates, and also that people go, it's still relatively affordable to rent an apartment in a way that buying one is not. So as the biggest player in this space, it should do well.
I was going to say, any concern with demand maybe dropping as the rates come down and housing prices has come down as well? People start looking at that?
It makes housing more affordable. One of the reasons that apartment REITs have not been doing well is that the lower immigration numbers, thanks to the change of government policy. But you actually had a big takeover in this space. Interrent got bought by its previous CEO and the Government Investment Corporation of Singapore at pretty much its NAV earlier this year, which is a pretty good marker of, and that's quite a similar portfolio in terms of geographical location to cap REIT. So it's quite a good marker that those NAVs are real, and therefore that you ought to see some narrowing of the discount at the very least.
Okay, and last up is Suncor.
Well, the one commodity that has not been getting a lot of love, as you were saying in the commodity price boards earlier in the show, is oil and gas. And we hit a 5-year low for the West Texas, and obviously there's the further discount for Western Canadian fuel, although actually the expansion of the Trans Mountain Pipeline has narrowed that discount quite substantially. But in the meantime, companies like Suncor and CNQ are just gushing cash, even at these very low oil prices. And they are not going out and spending it on overpriced acquisitions. They're buying back stock. I think Suncor's buying back $3.3 billion. Rich Kruger, the new CEO, came in a couple of years ago from Imperial, has much improved their operational performance, particularly on the safety side. And in the meantime, again, you get a 4.5% dividend yield while you're waiting for this to improve. So it's notable that the one commodity that has not done well is oil. But again, the cure for low prices is low prices. If prices stay this low, you're going to get a reduction in supply, which in turn will encourage more demand. Low prices will encourage more demand. So we think this is an area you should look at as one of the big laggards.
Okay, we'll wrap it up there, Gavin, but we'll be back. Stick around, please. And we're going to break down Canada's GDP for the month of October with Dominique Lapointe of Manulife Investment Management. And our phone lines will open soon for our first call segment, 1-855-326-6266. You can email us, first call, bellmedia.ca. Copper hit a fresh all-time high above $12,000 US a ton. Severe mine outages and trade dislocations linked to the U.S. administration's tariffs put the crucial industrial metal on course for its biggest annual gain since 2009. The impact on global trade flows has been so extreme that prices have rallied, even though underlying usage has deteriorated rapidly in China, which consumes about half of the world's copper. The Canadian Pension Plan Investment Board and Goodman Group have agreed to set up a multi-billion-dollar European data center business. The Australian Industrial Property Investment Manager and the Canadian Pension Fund Manager will initially invest close to $4 billion Australian dollars to develop data centers in Frankfurt, Amsterdam, and Paris. Construction due to start by the end of June. Alphabet has agreed to buy clean energy developer Intersect Power for $4.75 billion US in cash plus existing debt. This is one of the largest deals by the tech giant to expand its data center footprint in AI. The acquisition is intended to give Alphabet's Google access to more electricity for its data centers. The AI race has spurred mergers and acquisitions in the data center and power industries. And looking at the markets, fairly quiet right now. They're off slightly south of the border, the futures, as they wait the market open. See what happens, though. The Christmas rally continues. Well, Canadian GDP for the month of October is out, and real gross domestic product decreased 0.3% in October, offsetting a 0.2% increase in September, driven by contractions in goods-producing and services-producing industries overall. 11 of 20 industrial sectors contracted in October. Now, the total value of investment in building construction edged down 0.5 to $22.3 billion. Let's break it all down now with Dominique Lapointe, Macro Strategy Director at Manulife Investment Management. And thank you very much, Dominique, for joining us today with these numbers as they're just coming out right now. They're right on point with what the expectations were. Is there anything within it that is surprising, though?
Well, it's on the consensus. So on that front, this is not that surprising. 0.3% decline, to give the audience the context. That's the steepest drop since December 2022. However, like you said, with Statistics Canada, there are often some distortions that can impact that headline number. So this morning, StatsCan's mentioned there was a teachers' strike in Alberta that impacted services, and at the same time, there were mentions of retooling in some of the manufacturing sectors that contributed to a large decline in goods-producing industries that month. So if we've discounted for a little bit of that, it's not that worse, but the overall trend or the overall message, I think, is still intact, which is that the seeming momentum that the Canadian economy has gotten out of Q3 might have faded.
Gavin, do you want to jump in? Or
Yes, absolutely. Because that momentum we saw in Q3, correct me if I'm wrong here, but some of that was simply that imports fell quite sharply, and obviously that automatically increases GDP somewhat. Would the weakness we're seeing, or the slightly weaker result for October, play into that story as well?
Yeah, some of it for sure. Like you mentioned, the Q3 GDP print was very strong because of a drop in imports, and in the end, final domestic demand, which measures consumption and business investment, was quite weak. And what we see this morning isn't really contradicting this. Like retail sales, for instance, doesn't do much. And if you look at both retail and wholesale on a year-over-year basis, they're slowing down. So it's not necessarily particularly good news, despite numerous mentions that the labor market has improved. Probably that the labor market has stabilized, but to say that it really improved is a stretch. So I think we are still in the same weak growth, somewhat weak labor market environment that we need to consider for 2026.
And what are you thinking about for 2026 when you look at these numbers? I know we still have a couple of more months of data for 2025, but what is this pointing to you about what we might be seeing in 2026?
So I don't want to be overly negative this morning, just one day before Christmas. So there's a couple of bright spots if you look on a year-over-year basis. Even after this morning, for instance, manufacturing activity, despite this morning contraction, it looks like from the trough that it reached in July is rebounding. Again, somewhat discounting what happened this morning. So some of that uncertainty has been lifted, and we think that there's the consolidation is happening in that sector, and that businesses are slowly trying to either sell more to Canada or try to find other export market. On the energy front for 2026, we are even more optimistic. So we were reading that non-U.S. energy exports, oil and gas exports, are up 60% from a year ago. So that's quite a big jump. Same thing with LNG exports, which are up by 30% to non-U.S. markets, which essentially comes down to the BC terminal that happened this year. So I think both on the manufacturing front, which will take time, and on the energy front, which is happening much faster because there's some infrastructure enabling that, we are more optimistic. Similarly, the construction industry is holding on well, generally speaking. And for 2026, hopefully with programs such as Build Canada Homes, combined to provincial and municipal programs, we continue to build more homes in the country, and that both stimulate the resale market, but at the same time the construction market,
which we also may be seeing slowing down because the population's dropping here, and those issues are a concern. Have you done a breakdown yet of what would happen if CUSMA falls apart and we have to rethink everything?
So the scenario that we looked at and we think has a high chance of happening, which we maybe bank on close to 50% chance of happening, which would not completely remove CUSMA, but leave Canada facing a baseline tariff anyway, between 10 and 50%. So that we think is a realistic scenario for next year. That would not trigger a recession per se for Canada. But what it would do is that for the first half of the year, when the process is ongoing, it would leave more uncertainty. And when the tariff kick in, it would prolong the adjustment period. So instead of looking at going back to, from a technical term, trend growth at the end of 2027, you would push that back at least a year and a half. So when analysts refer to Bank of Canada hiking, if we face a baseline tariff, I think it really delays the moment when this becomes necessary.
Possible rate hikes?
Yes.
And how would that play against the U.S. Looking at rate cuts?
I don't think that this would be a major problem if Canada, which the Bank of Canada leaves its policy rate at 2.25%, and that the Fed continues to cut. If anything, the Canadian dollar has been quite weak over the past year. So I'd say a modest appreciation towards 75, 76 cents, perhaps even 77 cents would not become that much of a major issue. Even to exporters, we don't think that a 5% appreciation of the Canadian dollar, for instance, based on rates differential, is the most factor pushing down the exports right now. It's mostly the tariffs and the uncertainty.
Okay, Dominique, we're going to have to wrap it up there, but thank you as always for joining us.
Thank you.
Dominique Lepoint is Macro Strategy Director at Manulife Investment Management. Still ahead, we'll update you on the U.S.-Venezuela conflict. And our phone lines are open. Gavin Graham is taking your questions on North American and global large caps. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. U.S. President Donald Trump, speaking at a news conference at his Mar-a-Lago estate on Monday evening, warned Venezuelan President Nicolas Maduro not to challenge the U.S. and vowed to keep oil seized from a supertanker. The U.S. stepped up its blockade of tankers going to and from Venezuela over the weekend. Bloomberg's Brian Fowler reports.
This U.S. campaign in the Caribbean continues to evolve. It started, of course, as an anti-drug trafficking operation and has now become something a little bit more amorphous. The U.S. over the weekend boarded a second vessel, a Panamanian flagged ship that had recently loaded Venezuelan oil. Apparently, it had turned off its transponder, so that's been boarded. And the U.S. is also currently in pursuit of a third ship, the Bella 1, which it has determined is not flying a valid national flag. That ship has resisted efforts, all calls to stop, and a pursuit is underway. And as we had heard earlier, Trump is saying that he's going to keep the oil. He's also threatening President Maduro not to fight back. If he fights back, he will never be able to fight back again. Trump has stopped short of saying that this is all about regime change, but people in his cabinet have been a lot more clear on that. Homeland Security Secretary Kristi Noem said that this is about much more than just seizing the oil. He has to be gone, she said. So all these actions, they've been criticized at home and abroad. China, which is the biggest importer of Venezuelan oil, has criticized the actions as illegal. And then at home, Kentucky Senator Rand Paul has said this looks like a prelude to war.
Yeah, and we got some sort of immediate headlines there for what is going on off the coast of Venezuela, but there was also some announcement about much longer sort of strategic ambitions for the warships of the United States. What did the president have to say about that?
Well, I mean, he's announced a new class of battleship that's named after him. They've even got the name of the first vessel, which is called the USS Defiant, which seems, I'm sure he named personally, it sounds like. But this is all about advancing the capabilities of the U.S. Navy. This new class of battleship apparently would be firing laser beams at targets, and it's meant to make the whole Navy much more efficient, is what Trump said.
That was Bloomberg's Brian Fowler. Still ahead, we'll take a look at some of the notable analyst calls and recommendations, including an upgrade for Emitech. Time now for some notable analyst calls and recommendations. TD Cowen is out with 3 new analyst ratings for this morning. Let's start with an upgrade for Emitech, a global manufacturer of electronic instruments. They've been raised to a buy, with TD Cowen setting a price target of US $230. On the downside, the firm cut its ratings of Janus Henderson to hold with a price of US $49, price target that is. And finally, TD Cowen has resumed coverage of WSP Global, the Canadian engineering consulting company, with a buy rating and a price target of Canadian $335. Well, Canada's sovereignty has faced pressure during U.S. President Donald Trump's second term, leading Prime Minister Mark Carney to prioritize military investment. CTV's Judy Trin has an update on it.
Canada's new government will rebuild, reinvest, and rearm the Canadian Armed Forces.
The Prime Minister's clarion call to defend against a superpower's imperialism.
What I'd like to see, Canada become our 51st state. We give them protection, military protection.
Donald Trump turned his threats into a trade war, pushing Mark Carney to turn the military into an economic shield.
I'm announcing today that Canada will achieve NATO's 2% of GDP target this year, half a decade ahead of schedule.
Carney's first budget invests nearly $82 billion in defense over the next 5 years. There's more money for recruiting, training, and equipment. Soldiers are getting raises and bonuses for serving overseas and deploying in the far north.
The priority is the defense of Canada and the Arctic. So we are investing both in terms of capabilities, but also in terms of planning and programming.
Climate change has made Canada's Arctic and its natural resources vulnerable to foreign intrusion by Russia and China. Better weapons are needed to patrol from the land, sea, and air. In the past, 75% of procurement dollars went to American companies. That's being reduced.
We're not going to be spending 75 cents of our dollar south. We'll be amortizing that money out in Canada where we can, and then spending it in other places where we have to.
The Defense Investment Agency, created in October, aims to ensure that Canadian companies benefit from big procurements, like the plan to replace a fleet of aging submarines. The Navy wants 12 conventional subs.
The reason we need submarines is very simple. It's the only technology in the Navy that guarantees that we control our waters.
That's the first one in Canada.
There are 2 competing bids. The Prime Minister visited TKMS, the German-Norwegian conglomerate, in the summer. Then in the fall, Carney visited the South Korean rival, submerging himself in Hanwha's proposal.
I'll be back in 60 days.
The contract, which includes manufacturing and maintenance, could be worth more than $100 billion. The winning bidder is expected to share the rewards.
Buying Canadian, both in terms of steel and aluminum. So that's not a surprise. I think for both submarine manufacturers, they would be looking at that. Obviously, the question of servicing these vessels over time. I mean, remember, this is a long-term investment. We're talking 30, 40, maybe even 50 years.
While the submarine supplier will be chosen next year, the decision on fighter jets is still up in the air. Canada has already purchased 16 F-35s from the U.S. With Trump's tariffs, whether to buy more is being reviewed.
I don't believe that we've had enough jobs created and industrial benefits done out of the F-35.
Then there's the Swedish charm offensive. The King leading the charge to pitch the Gripen fighter and offering to build the Nordic jet in Canada.
The government's steps to diversify our defense and trading relationships are absolutely crucial, but need to be accelerated.
The military budget will continue to increase over the next decade. The Prime Minister, along with NATO allies, has committed to spending 5% of GDP on defense by 2035. That will equate to roughly $150 billion a year, the cost of defending Canada's sovereignty. Judy Trin, CTV News, Ottawa.
And when we come back, Gavin Graham will take your questions on First Call. All right, time for First Call, and this time it's first email, and it comes from Sunny, who says, "Good morning. What does Gavin think about Ivanhoe as a copper play right now?" Gavin.
Well, Roger, copper, Ivanhoe is having some issues with its mine major mine in the Democratic Republic of the Congo, where there's been some water leakage and they had to remove their production guidance. Having said that, there's an enormous new platinum, palladium, and gold and copper mine in South Africa, which Robert Freeland was just opening with Cyril Ramaphosa, the president of South Africa, earlier this month. It's something like $2.5 billion in terms of investment, and it's been on the blocks for a very long time. So to actually have ground broken is very encouraging from that point of view. Because again, platinum, palladium have also been benefiting from the boost in precious metals, even though people have had worries over platinum, because obviously if you're switching from gasoline-powered cars to electric cars, you don't need as much platinum for the catalytic converters, but platinum is still being used quite a lot. So Ivanhoe has this big new mine coming in, even though its existing copper mines are having some operational issues. And it's one of a good reminder, I think, Roger, that mining is tough. You know, these are difficult operations to run, and stuff always goes wrong somewhere. But Ivanhoe's got a pretty good track record at running them and finding them. And as I said, they have this big new mine coming in, so it probably looks quite attractive.
Okay, let's move on now to an email from Bruce. Should I sell my CNQ if oil is expected to crash?
Absolutely not. And for a start, you could say with oil at 5-year lows, it's had a pretty good crash already. What was it, beginning of this year? $80?
I think so, around there.
Yeah, and it's Brent is 62 or thereabouts. So I think oil's down 25% this year, and yet companies like Suncor, which we were talking about, CNQ, are off a bit, 5% maybe, because they're still enormously profitable even at these low price levels, because they have some of the lowest cost production. I think CNQ's oil sands production, it's about $21 a barrel production, all in production cost. So you're still making lots and lots of money. Murray Edward run company is always pretty well run, and they have done a great job of expanding their production and also raising their dividends. So do not, if you're going to keep one exploration and production company, keep CNQ.
All right, and let's move on now. And Fred is up next, and his question is your view on Whitecap.
Well, again, talking oil and gas, and I think the firstly, the senior management's been buying some stock, which is always an encouraging sign. When insiders are selling, there are lots of reasons why they might be selling, whether it's tax planning or they want to buy a new house or whatever. When they're buying, it's a pretty good sign of confidence because they already have a lot of their net worth exposed to the company. And they were making the comment at the time that they are strongly profitable, even with $50 a barrel oil. The dividends being maintained, it's almost a 7% dividend. So again, the fact that it's down somewhat this year is a reflection of what's happening with the oil price, but the companies themselves have been doing a lot better. Stick with it.
Okay, and we're going to sneak in one more email. We're getting through these nicely. It's from Dave. He says, I've owned Visa now for 10 plus years. I add it when it dips. Last edition was at $270 in 2024. Would appreciate your thoughts on Visa. Add more now or wait for a market drop?
Well, Visa and MasterCard have been the big long-term winners, and well done for getting in over 10 years ago, because they're not exposed to the credit risk. They are, they take a fee on every transaction, although there is some pressure on those as you're getting some electronic fund transfer businesses coming into that space. But interestingly, it's not been doing especially well. I think maybe it's up 10% in the last year, and over 5 years, it's only up 60-odd%, along with MasterCard is about the same. Because maybe the volume of transactions is down somewhat because of COVID, but also maybe because, again, you've done so exceptionally well in these companies. They are really a play on global growth, on volumes of transactions. And if that growth in the volume is somewhat weaker, then they're not going to do as well going forward. So it's still great to keep, but it may not necessarily do as well as it has done over the last 10 years.
Okay, I think we're going to wrap it up there. Actually, I was going to ask one more question, but we're almost out of time. Gavin, thank you for joining us. All the best for the holidays. We appreciate you being on the show.
Absolutely, Roger. Always a pleasure to be with you, and have a great holiday.
Cheers. And that's Gavin Graham, Chief Investment Officer for Spire Wealth Management. That is it for us for today, and he's up with the open next. The markets will open in a little more than 30 minutes from now. Have a great day and a great holiday.